Okay, recording this video Friday 28th of March 2014. We had a great trading day today. Hope you made good money. I will do a review of today's kind of trades and setups later on this weekend, but there's something on my mind. It's been kind of rattling around in my head for a while, and the best way for me to get it out of my brain is to put it out on video. So here we go. Here it is. I've called this thing the single most important driver of house prices that no one talks about. Maybe a little bit of an exaggeration, but that's definitely how I feel about this topic. And you're probably thinking, well, geez, house prices, we've had a correction in the US. They're down, somewhere between a third to a half, depending on which kind of location you're talking about. Sick of hearing about house prices if you're an American. What's the point kind of going through this? But, a large number of subscribers to Emini-Watch are outside of the US, and we definitely have housing price bubbles happening in places like San Francisco, possibly New York, certainly London, Paris, Berlin, Hong Kong, Singapore, Sydney, Melbourne, kind of back in my neck of the woods in Australia. And so I think that is kind of useful to just kind of roll through this just kind of quickly. And just as a little way of background, this is just looking at some statistics for Emini-Watch. So, over the last couple of months, gone through 2 million visits to the site, which is kind of cool, and 57.74% of those are from the US. The remainder are for places that are in the middle of kind of bubble territory in housing prices. Canada, especially Vancouver, the UK, especially London, Australia, Melbourne and Sydney, Germany, Berlin especially. India, I don't know what's going on there. Certainly France and Paris. Italy, they've come off. Spain, definitely come off. Singapore, yes, we've got kind of bubbles happening there. Russia, Israel, sorry, don't know the situation there. But, so I think it's a topic of interest to subscribers to Emini-Watch. So let's go. The reason for this video came about out of a conversation that I had about 18 months ago with an extremely close friend of mine who lives in London, does extremely well for himself and his wife, and they're talking about their house. Got a gorgeous house in London, done a huge number of renovations to it, and it's just spectacular. It's kind of home that's in Vogue Living or something like that. And he says to me, I ask the question, what are you planning on doing? Are you going to kind of move out of the city? Going to retire? What are you going to do? He says, well, property prices in London go up at 10% a year. So after the next 5 years, I calculate we'll have paid off the mortgage and the renovations, and what we'll do, we'll sell the house, buy a small apartment in the city and a big house in the country, and just relax a little bit and kind of take it easy, work a little less hard, live in the countryside during the weekend, and kind of commute into the city. Seems like a sensible kind of plan. But his comment about house prices in London go up at 10% a year kind of just had me kind of flabbergasted that they thought that was what happens, and clearly, he was right over the last 18 months, definitely. This is an article taken out of one of the UK newspapers in the last couple of days, and the property market in London went up by 13.8% last year. The average price here, just down at the bottom of that shot, is £414,000 for an average kind of house in the city, and that works out about $690,000 US dollars. So, pretty pricey. And the London market is quite different from the rest of the UK. The rest of the UK kind of property market is definitely soft, but the London market has continued to kind of power ahead. And we've got a lot of kind of people moving into London. We've got mass emigration happening from Italy, from Spain, from Portugal, to London. All the English speakers with good qualifications who can move to London. I was amazed last time I was there, the number of people that were working in retail behind a counter who were Spanish. I just couldn't believe it. So there's a lot of kind of demand at the moment, but this kind of assumption of a 10% growth per annum in house prices, is that kind of sustainable? Do you understand what's actually kind of driving the prices? Now, some of the numbers I'm going to show you here are taken from Australia, but they apply worldwide. And I originally came across this kind of piece of analysis. I had to do it for a client back in the day, you might not know this before I kind of went out and did E-mini trading full time. I used to be a strategy consultant, and I worked freelance for about 15 years after coming out of a fairly major kind of international house. One of our clients was in the building materials industry, and they said to us, we'd like to understand when the next kind of boom period in house prices in Australia is going to come about. Can you kind of figure that out? So I'm kind of the analyst in the group. I'm set on my way, go and find the data, figure out what the answer is. And so I pull in all this data that I'm just about to show you, and for the life of me, I cannot understand why house prices have gone up so fast in Australia. Exactly the same principles apply in all of the markets I'm going to talk about, in the US, in all of those European markets, anywhere that has, a developed financial service sector. Just as a case in point, one of the least developed historically financial service sectors in Europe was Germany. And Germany, with their latest kind of somewhat deregulation of the financial sector, has allowed these exact same principles to start to take place. We never used to have housing bubbles in Germany. They were kind of the sensible man of Europe. But now, just lately in the last several years, the Germans are kind of got the property bug, and you can see it in particularly Berlin, kind of apartment and house prices. But anyway, so here's the piece of analysis. And this goes back to 1970. It uses the Melbourne median house price. There's extremely good data in Australia for all these things. But again, whatever the market, the same factors apply. And I would suggest that around the world, in these developed economies, the same type of multiples of change to have happened across all these markets. Australia, you might never have visited or been. You might think it's kind of just a quirk of nature or some kind of freak country down under. It's not. We're very like a lot of the US, a lot of Europe. It's not all that different from the rest of the world. And an extremely advanced financial economy. We have major banks that maybe didn't get into the trouble that the US banks got into. They did that earlier on. They did that in the 91 kind of property boom. But the same things apply, let me tell you. So what have I got on this chart? Back to 1970, house prices. Didn't put it on a log scale, just couldn't put it on a linear scale. You can see house prices in Melbourne, median house prices in Aussie dollars, going up to almost 600,000 Aussie dollars. The exchange rate with the US kind of fluctuates. We're around, kind of 91 cents at the moment. We have gone as high as, 110. So, if you think of it as a parity with the USD, so about 600,000 USD, kind of give or take. So what are the components that drive kind of house prices going up? You'd expect a number of kind of fundamental things to have changed over the years. One of the ones I've not included here is the population change, because demand and supply. As the population grows, the builders build more houses. There are some markets that are more constrained than others. Sydney is a constrained market because it's geography-wise. There's only one place to expand out west. Melbourne is less constrained, so we've had the same kind of house price development that you can see kind of around the world. So, you could look at population growth as being a factor, but I've not included it here just because as the population grows, we just build more houses. But what drives the price? So here are some fundamental drivers of price. Let's start down at the bottom of the range here, and I've got earnings. And this is the increase in the average wages of people in a household, and you can see it's kind of grown nicely, and it accounts for a fair portion of actual house prices. This top line, the blue line, is the actual house price growth, and this portion of it is accounted for the increase in wages. The second driver that we can layer on here is the number of earners per household. So, back in the 70s, on average, we were talking about one worker per household, and over that time period, we have part-time workers, women entering the workforce, and so on. And there's been an increase in the number of workers per household, and that accounts for about, a little bit more, an uptick more. And we've gone for an average about, one worker per household to 1.2 kind of full-time workers per household. So that's the next little blip up, which is kind of the number of earners in green there. And then we look at the next kind of big jump up, and this is mortgage stress. This is the amount of money that you are willing to pay to buy a home. So the amount of your income, the percentage of your income that you feel is an appropriate amount to spend on housing. Traditionally, back in the day in the 70s, the kind of the leverage and what people were comfortable spending on was probably around 30% in Australia, about 30% of their income going on buying a home. But over the years, as house prices become more expensive, people are allocating more of their income to buying homes, and that's gone up on average to, I'm kind of back calculating, about 40, 42, 43% of their income at these kind of bubble levels that we're at the moment. Mortgage stress, I think, is technically defined by the economists at around 50%. As soon as you're spending 50% of your income on your mortgage, you are seriously under pressure. And then the next kind of fundamental factor is the term of the loan. Back in the 70s, we were far more conservative. We wanted to pay off your loan as quickly as possible. And so, although some people achieved maybe paying off a decent-sized mortgage in 10 years by saving and paying it off as quickly as possible, on average, mortgages were kind of about 20 years. But latterly, in the last 10 or so, the standard has gone up to 25 and is actually closer to 30 years now. So the average mortgage in Australia is termed at 30 years. And that, again, so all of these factors, I would suggest, are very similar across all of these kind of developed economies. You'll find this exact kind of growth rate kind of going on. So what's the point? The point of adding all of those kind of fundamental drivers together is you get to 2/3 of the way there. So you've got a huge missing gap of 1/3 of the house price growth there that's happened that's, let's say, unexplained. What's going on? Well, there is an explanation for it, and it's called leverage. And so the colors have changed on this graph. I apologize, I'm not all that good at using this as Google Drive spreadsheets at the moment, so they've recolored them for me. But you've got exactly the same kind of things going on here. You've got the earnings and number of earners. You've got the mortgage stress and the mortgage term kind of going on here. Here's the blue line shows what the actual prices has done. So how do we fill the gap? What is the factor that kind of allows us to match that house price, the actual house price, with using kind of more fundamental data? And it's what we call leverage. And this is what's happened, and this is the one driver that no one talks about, and no one really understands the power of it. It is massive, absolutely massive, and I'm going to try and explain this to you. So, since the 1970s, loan to valuation ratios have gone from about 60% to 90%. So what does this mean? This means the amount of money that the bank is willing to lend you to buy your home. So back in 1970, the bank wanted you to pretty much save about 40% of your of the house price, and they would contribute 60%. Well, over the years, the house prices go up and up. The banks become more comfortable lending, and that ratio goes up. And at crazy kind of silly times, it's gone to, in certain instances, actually above 100%, to 105 or 110 in just some kind of cases where, for example, the homeowner is actually not just getting a mortgage for the value of the home, but also to fund some renovations that can then be used to kind of revalue the home. But the average loan now is up at the 90% kind of loan to valuation ratio. Again, all of these things are similar type numbers across all of the developed economies. And the impact of this change by the financial institutions going from a more conservative ratio to a far more aggressive ratio has been driving that gap in house prices. Going back to the Germany example, Germany was one of the slowest to kind of deregulate their financial sector, and traditionally, up until about 10 years ago, in the German market, the banks would only lend about 40%, and you had to put 60% down. And as the financial institutions deregulation kind of comes along, you have kind of solid house price and experience elsewhere, and other lenders kind of come into the market, and we have kind of third-party type lending going on. That ratio has gone up and up and up. So the Germans, who are traditionally an extremely conservative kind of nation in terms of house price growth and what you could borrow from the banks, has changed, and that's starting to bubble up in markets like particularly Berlin, where there's a lot of kind of foreign interest in kind of buying apartments and houses. So this is this leverage factor, 60 to 90%, and let me show you what that kind of means and go back to my example of my good friend in London. A 1% increase in the loan to valuation ratio does this. So let's say you've got $100,000 as deposit and the bank's lending 90% at the moment. That means they will approve, assuming you've got earnings, in that vicinity that you can pay off the mortgage. And at the moment we've got kind of record low rates in mortgages, so the mortgage stress is still high, but relatively the mortgage is cheap. that means the value of the property that you might be allowed to buy is about $1 million. So 90% leverage gives you $1 million. If the bank internally just goes up to a 91% leverage ratio, that same $100,000 will translate into a property purchase of $1.1 million. So just a 1% change in the loan to value ratio accounts for a 10% increase in property. And in my mind, that's what's going on in London and these other markets around the world. And that explains my good friend's kind of comments. Property prices in London go up at 10% a year. They have been for the last 10 years or so on average, and they will continue for the next 5 until I choose to cash out. So and that's probably what's happened. The leverage ratios in London have gone from probably about 80% 10 years ago to closer to 90% now, and they just have to go a little 1% a year on average. And that accounts for this 10% change in property prices. It's the single most important driver. Earnings aren't changing all that much. I mean, unemployment's not really changed in the last few years. All of those kind of other metrics that we kind of look at, none of them have changed all that much. But just a 1% change in this LVR will account for that change in property prices. So in my mind, that is the single most important driver of property prices, and it's not even on the radar screen for a lot of people. Interestingly, after the property collapse in the US, those LVRs became far more conservative. They went way down, and their lending criteria became a lot tougher. We got a couple of friends in the San Francisco area that were saying it was very difficult to refinance their mortgages. They were looking at fairly sizable mortgages, jumbo mortgages, but the banks were really getting very tough on refinancing any of those things because their criteria just got taken in massively. And that's the point. The point of this video is, so what? This loan to value ratio is at the moment in these markets a virtuous feedback loop. So as the property prices continue to go up, the banks say, well, this is a good asset. I can increase the loan to value ratio because the price keeps on going up. But they don't understand. Well, I'm sure they do. There are people that really do understand this, but I'm not sure the man on the street understands, and the bank teller in the bank understands that they're contributing to this spiraling house prices just because the price keeps on going up and they keep on raising their LVRs. So it's a virtuous loop that can easily just reverse and become a vicious feedback loop and a vicious circle that kind of goes the other way. If they reduce their LVRs just from 90% down to 89%, it looks kind of trivial on the back of the banks, but that's a 10% decline in house prices, just there. The second thing to note is that we're at these kind of limits. There has to be a limit at which LVRs go to. I mean, we talked about going to 100% and 105 and 110%. Those are kind of outlier examples, but I mean, we're not going to go to 100% LVRs. 90 plus at some point, banks say, this is crazy. The amount of capital I ought to be allocating to these potential risks. So there's a limit there in terms of the LVR. We've done the easy stuff. The easy stuff was going from 60% to 80, 85%. Now we've gone to 90. We're kind of pushing it. Every extra 1 or 2% there is really starting to make a difference in house prices and also go towards that level of instability. The second thing is mortgage rates are incredibly low right now historically, and so that makes things seem a lot cheaper in terms of mortgages. Your bang for your buck. But as soon as the rates kind of start to rise, that mortgage stress will go up. And then population growth. We've been lucky with baby boomers and the last boom that we've had in property prices. And if you kind of listen to any of Harry Dent stuff talking about population kind of cliffs and things kind of slowing down as the baby boomers retire, and we don't have the kind of the echo boom kind of coming along, or the immigration that needs to kind of sustain these kind of demand, that starts to slow, and that kind of starts to play into the equation. So that's my so what's. For me, it means that I'm happy as a property owner to hold property, but not looking to make any new investments in property for a couple of reasons. First of all, property for me is now a rental yield, not a capital gain investment. I really don't track the value of my property anymore. What I am concerned about, though, is what the rental yield is on that property. And then there's no reason to buy at these kind of elevated levels until prices revert to the mean. And it's interesting, I'm sitting at the moment in Kauai, northernmost island of Hawaii, and the property prices, we've seen over the last 5 or 6 years, they've corrected massively, 50%. And now, compared to back home in Sydney, they look damn good value for money. But I think there's another little downtick going to happen in US property prices. But at some point, when they do kind of revert to mean, they become far more reasonable, then acquisition is kind of on the cards, but not for the reasons of capital gain. In my mind, it'll then just become a rental yield kind of game, kind of going forward. So there we go, just some thoughts. Glad to have got that out of my head, so they won't be rattling around in there anymore. Just on the most important driver of property prices that no one talks about. Enjoy your weekend.